All right. So again, this class is being recorded for posting on YouTube. So before we get into the content today, any important news and events that has happened in the last couple days that are worth mentioning? Yeah.
Yeah, the government just implemented a tapering from $70 billion to $60 billion.
Yes,
And
there's,
to PQ.
so they knocked about $10 billion off of the bond buying, so the taper we talked about on Monday. And yeah, that was actually right here when the market plummeted right after that. That was the impact, the immediate impact of the tapering. So again, the Fed is basically saying we think the market's strong enough to absorb it, but obviously there's a lot of anxiety in the market because they are lifting some support, which is going to essentially probably put more pressure on interest rates. As a matter of fact, if I had to guess, then the yield to maturity on the 10-year, well, right now it's at 2.71. I'd be curious to see how this changes in the next few days. All right, because if they cut back on the tapering and this rises, that's what they don't want to see. They don't want to see this number start to go up very much. So that's something we'll start to track. All right, what else happened between Monday and today? Yep.
Last night was the State of the Union, and we went over, he wants to increase minimum wage.
So one thing is they basically want to have the minimum wage at $10.10. Based on the reaction of the chamber, it doesn't appear the Republicans are quite on board with this. So in an election year, curious to see whether that really happens. But if nothing else, he unilaterally said he was going to do it for federal contract workers. And I guess that's, 500,000 people? So that could benefit a few people. Yeah. Yeah, so one of the things is we talked about Apple on Monday. They released their earnings, and their stock price has not done that well. As a matter of fact, if I go back to Bloomberg and we look at Apple, over the last 3 days, they reported earnings. Market next day traded down substantially. Today they closed right around $500, or they will be closing somewhere around $500, about 25 minutes. So why? Why this big negative reaction to Apple? Because if you actually look at the earnings estimates we looked at on Monday, they met their revenue targets. They met their earnings per share target. Yeah.
I had read that their iPhone sales were disappointing.
That was the challenge, is they missed the amount of iPhone sales. So they ended up selling more iPads and other stuff, but they sold fewer iPhones. And with iPhones making up now the majority of their revenue, that's the one, and a lot of their profits, that's the one the market has been focused on, particularly after Samsung disappointed whenever they reported recently. They wanted to see if Apple was in the same boat, and Apple's iPhone sales were down. So specifically, the market was expecting how many iPhone sales? It was 56 million, and they actually reported 51. So they're about 5 million iPhones less than what you thought. All right. Well, that's important because there's a company called iFixit, and every time a new iPhone or any magic device, any electronic device is magical device, Steve Jobs would say, is released, they do an autopsy on it. They literally, and they do this on camera. There's a bunch of really interesting people that watch them dissect it screw by screw, and then they put it out very neatly on a piece of paper, or on like a quilt fabric. And then what they also do is they then price it all. So they basically say they're trying to figure out what the cost is of the iPhone. And according to the iFixit cost, the wholesale cost is about $220 for the iPhone 5S. They sell these things starting at $650. So the 16 gig model is sold to the carriers at $650, cost them about $220 to actually build it. That's why 5 million less iPhones is a big deal, because they're making profit margins of almost $400 per phone. And when they don't sell as many phones, it really starts to dig into their future profits. And so that's the thing, is that most of that iPhone loss was in North America. That's what they said on the call. And actually, Raymond James came out with, the analyst, came out with a report today where he said that he believes most of the loss was because of AT&T and Verizon. And so he basically said AT&T and Verizon saw their iPhone 5S sales go down versus the 5s last year. They sold less of them, and that was the primary reason they missed their sales targets. Now, that's important because still in today's world, most of people's cell phones are going through the carriers, right? They're not going through the Apple stores. And so if the carriers aren't pushing the phone, then that's bad for Apple. And that was the other reason why there was kind of a pivot in their stock price, because it's then, oh, what happens with next quarter's sales and the quarter after that sales, and what does that mean to future demand, because they're losing all these sales where they're making over $400 profit per unit. They're not growing as fast as they thought. So what ended up happening, earnings estimates, is if you look at Apple's earnings estimates, you see these down arrows that are red. This means downward revision since Monday. So what's happened is all the analysts went in there, and the next 2 quarters, they slashed estimates for sales, revenue, profit, etc. And that's why the stock price adjusted. So I don't think they're going to sell as much as I thought. They're going to generate less revenues, profits, cash flows. Apple's not worth the same. 10% drop in their stock price. So kind of what we're talking about played out with Apple. Questions about that? Tim Cook on the call explaining the numbers did say that Apple's going to enter in a new growth category this year. He wouldn't say what it was, and they're probably not going to announce it on the call. They usually announce it in the summer at a conference. But basically they said there is some hope for growth with a new category. And basically that means either wearable devices, think iWatch or something like that, or basically mobile payments, iBeacon. So one of those two is probably what they're getting into. But since they were non-specific, everybody just focused on the iPhone sales disappointment. And so that was really the entire story of Apple's stock drop. It was the iPhone sales. All right, so where we left off on Monday is we were talking about the cornerstones of value, and we want to kind of continue from there. So one of the next things that we'll talk about is what we'll call the 4 financial tensions. And that what we have to understand is that a lot of the ratios that companies report are trade-offs. And one of the hot topics in the corporate world is there's a guy named out of Harvard that created the concept of a balanced scorecard. So all the companies out there think they have to have balanced scorecards. But the problem with a balanced scorecard is you can't balance the scorecard, right? Because some ratios are at odds with each other. So if one goes up, the other could actually go down, right? And so that is what I like to call tensions. So part of it is understanding what are the trade-offs that companies have to make, and what is the market looking for in terms of their trade-offs. So as an example, I mentioned I'll be doing some work at Santander, and I'm also going to be doing some work with BBVA, 2 of the largest Spanish banks. And as part of the EU, one of the things that's happened post-crisis of 2008 is the regulators have come down hard on the banks because they said the banks took on so much risk, they want the banks to take less risk going forward. So the way that the regulators have kind of implemented this is primarily through a framework called Basel III. Okay? And so the G20 nations got behind Basel III and said, we're all going to force our banks to follow these kind of common standards or fairly common standards. And so one of the things under Basel III is banks have to have lower leverage ratios, which means less loans relative to the equity in the business. So they can't make as many loans as they used to. Another Basel III limitation, and this one's actually more onerous to the banks, is that banks have to keep 30 days of cash, an estimate of 30 days of cash that could be withdrawn in a crisis as cash on deposit with the central bank of the country. That is unlendable, right? That's a real expensive proposition for banks. So I got to take 30 days worth of cash in a crisis and not lend it to anybody, keep it in the central bank earning essentially no interest, interest-free loan to the government. Now you can argue that this is actually in the self-interest of the European governments because what they're doing is they're using the cheap financing of the banks to finance their countries. But in any event, these are the regulators and they're allowed to regulate any way they want, and that's one of the regulations. But here's the impact of this, that basically the banks are having trouble making the same returns they did pre-crisis because they're not allowed to take the same amount of risk. And when they do take risk, the regulators start to question it. So the returns in the banking industry, return on invested capital, returns on equity, are going down. Well, relative to the cost of capital, banks are worth less, right? So banks have to deal with this. What do I do if I can't earn the same rates of return? Well, one manifestation of this is they can't pay the comps anymore. That the average bank used to pay 4 times the salary of the average worker. And banks can't do that anymore because they can't justify the returns, they can't pay the comps. And that's causing trouble with getting people to go work for banks. So I'm a graduate of the Wharton School, and one of the things Wharton reported is that about 40% of Wharton graduates in any given year go work on Wall Street. We're probably like the number one school that's a feeder school to Wall Street. But here's the thing. This year, less than 25% of the graduates are going to go to Wall Street. That the number one position that the Wharton graduates are all going after this year is they're going to Silicon Valley. They're working for the dot-coms, the new dot-coms, the tech companies, because they think that's where the money is. But it's also because the banks aren't paying the salaries and don't have any positions that they did at the same rate that they did a few years ago. Because again, the regulators are saying can't take the risk, can't get the returns, can't afford the rewards. So this is the way it'll affect you as an undergrad. You might have gotten a job working for JP Morgan Chase or Goldman Sachs, making $70,000 a year out of undergrad, and then next year you might make 130 or 150, and then the year after that, well into the 200s. Now what'll happen is you'll be hired for 70, you'll make 90, and then you make 120. They're going to slow down the trajectory of your growth in earnings, and the big bucks that were made historically are going to be far less available in the banking industry because the banks can't afford to do this. And all of the risk taking is being forced out of the banking system. So you really want to make the money, go to Singapore and work for a non-regulated financial institution. That's where the money is. That's where you'll make $150,000 within 2 years, right? Because that's how the market is changing, because they can take the risk, they can pay the rewards, and you're seeing some transformation of these markets. And right now, the regulators are holding firm. So Wells Fargo, JP Morgan Chase, Bank of America, they're the ones that are really suffering as a result of these regulations here in the U.S., but it's affecting banks around the world. So again, what we have to understand is what is happening to an industry? What are we looking for as investors, and what's going to matter to us on that risk-return trade-off? Another one is growth and return. What is the company's growth, and what is the company's expectation for return? When we talked about Royal Caribbean on Monday, that was the thing. Royal Caribbean was focused on growth at the expense of return. Because typically, to grow, I have to spend a lot of cash to grow, suffers the return in the short run. So if I do that, if I hurt my return, I got to figure out what is that future growth going to be. What's interesting is Apple is now being penalized because people are worried about their growth prospects, right? So essentially selling a few million less iPhones is causing panic about the future growth. Because now they're saying, does that mean the smartphone market is maturing? Does that mean that Android has finally taken hold and the iPhone won't get the price premium? Does that mean that the 2 major carriers in the US have decided to push Android phones over iPhones for their own benefit because they don't want to keep paying $450 subsidies to Apple for every phone that they sell when Samsung is willing to accept lower subsidies? And therefore I'll sell the Galaxy 4 versus the iPhone 5S. And is that playing out and Apple losing its grip on the market and people's view of the world? That's the panic that has kind of set in, that they're worried about the growth. What's interesting is if you look at a company like Amazon, Amazon's in a different state. Amazon, which is a $60 billion company run by Jeff Bezos, basically lost money. And their stock price went up 80 bucks. Now, how do you compare that with Apple? Amazon's a company that doesn't make any money. Amazon dumps all of its profits back into the business, has maintained low profits, yet they're a Wall Street darling. Amazon is one of the riskiest companies to own. And the reason why they're a risky company is because they don't make any money. They're losing money. And Jeff Bezos has said he doesn't have any plans in the short term to really make any money because he wants to invest everything to keep growing and to become dominant. Now, the reason why the institutions like Amazon is he has vanquished Circuit City. He has vanquished Borders. Both companies are gone thanks to Amazon. All right, you got Barnes & Noble on the brink. They're about to go bankrupt. You got everybody worried that Best Buy is going to be out of existence in a few years because of what's happening with Amazon. People are abandoning Best Buy to go to Amazon. And that was the bad quarter that Best Buy just reported at Christmas. Why do people like Amazon? What do you think? Just to put that into perspective, here is Amazon. Here is their stock price for the last 5 years. It's been on a straight line up. But if you actually look at their profitability, this past year, they lost money. On $61 billion of revenue. No money. And they're pretty much putting all of their cash back into the business. CapEx of $3.8 billion and $4.2 billion of cash from operations. So dumping all their cash back into the business to grow, and they're losing money. So, why is Wall Street so excited about them? Yep.
I would say because it's competitors that are brick and mortar stores. Once they presumably go out of business, they'll absorb some of those customers from those stores and hopefully get more profit in the future.
That's right. But here's the other key. HDS's holders. Most of Amazon stock is in institutional hands. These 18 institutions control most of their stock, including Jeff Bezos. It's the belief of these people. It's very few people that are betting on Jeff Bezos. And what I'm saying is they're not looking at the fundamentals today. They're looking at what they think will happen when Amazon is dominant and everybody else is gone. And they're saying Amazon suddenly is then going to make all these margins, all these cash flows, all this return, and then it'll be, nirvana, right? Now, I personally like Amazon. I just ordered some flannel sheets because it's cold as hell outside, right? And I'm an Amazon Prime member, so they'll be here tomorrow. 2-day shipping, free, love it, right? But here's the thing, I will not buy their stock because their $383 stock price is entirely dependent on the future expectations that these institutions have in Amazon. And if they ever change that point of view, as they just did with Apple, Amazon can fall very far, very fast. And so it's all about their unflinching belief in the growth of Amazon. And by the way, it's not just brick and mortar. It's the fact that Amazon controls about 40% or more of all internet traffic, right? Because basically, Amazon is Netflix. All of Netflix streaming is run off of Amazon servers, Amazon Web Services. It's a boring name, but they are the dominant player. That's why if Amazon ever has technical problems, everybody goes down because they and Google basically run the internet, most of the internet. So next time you're streaming on Netflix, you're actually streaming from Amazon. They're running all the server technology behind Netflix. So again, Netflix in any one given night is 28% of all internet traffic in the world is Netflix streaming. And it's all going through Amazon. That's why Amazon's making a lot of money off the internet, but that's the point. They're dumping huge amounts of money to build their infrastructure to make it even bigger. They are the cloud, right? But again, that's the point. There's a belief that that will eventually turn very profitable, that they'll turn their dominant position into the profits. And here's the thing. I'm not sold on that. And the reason I'm not sold on that is, let's say Best Buy does go away. Do you think Walmart's going away? And you think Walmart, what's Amazon doing? They're building distribution centers all over the country so they can do almost next day shipping or same day shipping. Walmart's already got that infrastructure. And Walmart's not going to sit idly by and just watch them go away while Amazon takes all this online market. And I'm telling you that these other players like Walmart and Costco and other firms are going to go more online because they don't have a choice. And so I think that, yes, some of the players are going away, but they're going to face new competition that when they look at their profits, and they're going to go after that competition. Because like I said, if I'm Walmart, I'm not letting my business go away. I'm going to do a fight. And I got a lot more cash than Best Buy does at this fight. And I got distribution centers all over the world. And I can quickly turn those distribution centers like Amazon did, if I can make them more efficient, and they're already pretty darn efficient, into things I can deliver online. So all I'm saying is I question whether Amazon will get the returns that the market expects. But that's, again, don't know, but that's why I avoid their stock. And I've been avoiding a lot of upside because I'm worried about the risk, because when these people change their mind, I'm very worried about the downside. All right, another trade-off, short-term versus long-term, feeds right into this. Long time ago, before you get old and fat, I was on the track team in high school, and I used to actually run the 1 mile. And it was miserable because we used to have to run quarters. So what would happen is, as part of our track practice, we had the pond run, where we'd run like 4 or 5 miles to kind of warm up. And then they'd bring us back and then we'd run intervals. So we'd run the quarter mile as fast as we could, and they'd make us sit for 5 minutes. And then we'd run the quarter mile and we'd sit for 5 minutes. We do that like 8 times. And I'll just tell you, it was miserable. Because about the 6th or 7th time you run a quarter mile after resting, Like, it's just horrible. But that's the point. If you're going to be what's called a sprinter or shorter distance runner, that's the way they train you. They train you for short sprinting distances. It's completely different than people that run marathons. That the way they train you to run marathons is you just run. You just run until you drop, right? So that's the point. Training to be a sprinter, training to be a marathoner, two completely different types of people. And if anybody here's a runner, you know what I'm talking about. But here's the real point. Companies run sprints and marathons simultaneously. And it's hard to do both. Because every quarter, we sprint to get quarterly results. Yet we're trying to make good decisions long term for our firm, which are like the marathon. And we got to strike a balance between the two, and it's really hard to do. So we got to understand what the market's looking for. In Apple basically meets the earnings expectation, misses the iPhone sales expectation, stock drops 10%, and the world is falling apart. Despite the fact they're doing great numbers. Short-term expectations are so critical for Apple right now. Amazon posts a loss. Stock price goes up $80 because people are more worried about the long term than the short term. We have to understand what is the view of companies as an investor that they care about. Are we thinking about the long term? Are we thinking about the short term? How are we going to judge you? And as a company, what am I delivering? Short term or long term value? And what does that mean? And how do I strike an appropriate balance? I also have to think about another tension called margin and cycle time, which is something we'll talk about today. So what all this leads to is that a company's worth the sum of its future cash flows. We know that from the academic data. So what that really translates to is all the cash we generate internally, the internal ROIC, will be the price of the firm externally. The external ROIC I own, or total shareholder return, total return to shareholders, owning the stock. There has to be an equivalence between the two because I get the cash flows the firm generates. So here's valuation. Tell me the price. I can back into the cash flows that justify the price. Later this semester, we'll call that an as-is valuation. If you tell me the price of a company, I will make you go into a model and create the cash flows that justify that price. Because otherwise, how'd you get to that price? Or, option two, you tell me the cash flows, and then I'll tell you what the price should be. That's the target price. Now, eventually, those two have to sync up because somebody's going to be right? Either the price today is right, and then the cash flows I have to come true, or the cash flows I think are coming true, and that will lead to a different price, and the company will adjust. But eventually, these two have to equate to each other. But it also means we can take different views of valuation. By the way, when people do multiples valuation, what they're doing is they're taking an external price, and they're assuming that the cash flows will equal that price. It's a different philosophy than DCF valuation, which is give me the cash flows, predict the cash flows, and I'll tell you what the fair value of the firm is, or what's often called the intrinsic value of the firm. But eventually those two have to sync up, otherwise there's arbitrage opportunities. And we have to be comfortable understanding both sides of the valuation equation. Margin and cycle time. This is a true story. Matter of fact, next Thursday, I'm going to be working at Company A. But this story started in 2008. So it started when I was doing some teaching at Wharton. And one of the advantages of Wharton is there's a bias that it's, best finance program in the world. So companies will often go there and they'll say, we don't understand what's going on with their stock price. Help us explain it. And that's what happened with Company A in 2008. Is they're trying to understand what was happening to their stock price. And they wanted an explanation. And here was the backstory. Company A and Company B, these are real companies in the real world, are competitors. They're peers. They sell the same products in the same industry. Therefore, they have the same cost of capital, same risk. They're making the same profit margins. They both made 8% profit margins on the same products. Same stuff, same margins. They're growing at the same rate. So, same growth expectation, same margin expectation, same risk, same products, same more customers. The only difference is, and the analysts agreed with every statement that I just made. I was talking to the CFO of A. He said, every analyst agrees with everything I've said. The only difference is the analyst said, don't buy A, buy B. And he said, I have a hard time understanding that. He's like, what do? They have pictures? Are they blackmailing like the analysts, Company B? And that's why they're getting all these buy recommendations on them and not me. And we joked about that. And he knew that wasn't the case. But he's like, why? Seriously, like, why is B, like, what is so attractive? You deal with the analysts all the time. What's so attractive about B, the analyst? And I said, what's your cycle time? He said, what do you mean by cycle time? Because cycle time is not a commonly used term in the financial community. It's really one that we're going to use in class that I think should be more used in the community. So I explained to him the definition of cycle time. Definition of cycle time, which we're going to look at this semester a lot, is from the time you borrow and spend $1 to the time you collect it from a customer, how long does that take? So how long are you tying up the invested capital? So spend the $1 to collection. How long does that take? In days. And there's a formula which we will use to measure the cycle time of any company. You need 2 pieces of data. The formula is, tell me what your invested capital is, divide that by your annual sales or revenue, and multiply that by 365 days. So it's the percentage of the year that you're financing, invested capital is borrowed money, divided by revenue, percentage of the year that you're financing, times 365 days. That's cycle time. He got it immediately, knew exactly what I was talking about. He's like, all right, I understand cycle time. So I was like, let's get out the 10Ks, publicly available data. Let's calculate your cycle time. Let's calculate your competitor's cycle time. Well, in 2008, cycle time of company A was 267 days using that formula. And the cycle time of company B was 135 days using that formula. So here's the business model. If I give A, as an investor, $1, they make 8 cents of cash profit every 267 days. If I give B $1 of investment, they make 8 cents every 135 days. What's more attractive for the same risk? B. Even the CFO of company A reluctantly agreed that he could see why B might look more attractive. Everybody with me on that? I want you to understand mechanically how this works. So, A and B start their projects at the same time. 135 days later, how much cash profit does A make? It's actually 0. It's not 4 cents. Why is it 0?
Because nothing's come back yet.
That's right. Well, the cycle time is how long it takes from the time you spend it to the time you collect the cash. They haven't gotten paid yet. On day 135, how much cash profit does B have? 8 cents. Because they get $1 of revenue paid and collected on day 135. They've spent 92 cents along the way. They now have 8 cents of net cash profit. On day 267, how much cash does A have? A, day 267. 8 cents. B, day 270. 16, because they use the same resources to sell product number 2. See, it's not just how much you make, it's how often you make it. It's the two together that the investor cares about. So what we do as investors is we annualize the data for comparative purposes. If you make 8 cents every 267 days, that's about 11 cents a year. If you make 8 cents every 135 days, that's about 22 cents a year. Would you rather make 11 cents a year or 22 cents a year of cash profit per dollar of investment? It's pretty obvious. That's why B is more attractive than A. By the way, A is a company called Raytheon, and B is Lockheed Martin. And if you want to understand why investors like Lockheed Martin, and they are the gold standard of investment in the global defense and aerospace industry, it's because they are far more efficient than their peers, and they have lower cycle times. Because what Lockheed Martin realized a long time ago is that every one of these companies sells primarily to the U.S. government. And the U.S. government is going to cap your profits. They're just not going to let you make extreme margins. It just doesn't happen. Even if you sign a contract with the U.S. government that allows you to make the margins, and it politically pops out that you make the extreme margins, they'll take it away from you. I mean, it's just, that's our government. So they can fight for a penny here and there, but generally all the contractors are going to make similar margins. But the government doesn't care about your efficiency. And that's what Lockheed Martin has been focusing on. So here's the point. In 2008, when I showed this data to Raytheon, I showed them that Lockheed Martin was all about the cycle time. So, like I said, I'll be there next Thursday. And what I'm going to do is I'm going to show them, using publicly available data, what's happened over the last 5 years. So here is Raytheon. Here's a preview of what they don't know yet that they're about to see. Here's Raytheon. And then I'm going to go to the RV screen in Bloomberg. And I'm going to show you later, a couple weeks, how to create your own custom templates. And one of them that I've saved is called ROIC. And here is the cycle time today of all the defense and aerospace competitors. Yes? Give it a shot. Is that better? Okay. So, no, still too much glare on that middle one. Sorry, we'll just go a little darker. Please don't fall asleep. There we go. All right, here is today. And one of the features of Bloomberg is I can go down here to select stats and I can do an average for their peers. But here's the deal. The average cycle time in the defense and aerospace industry is 214 days right now. Raytheon is 217 days. Lockheed Martin is 125. Now, what's the silver lining here? What's the good news I can deliver to Raytheon? I'm sorry? They're doing about the same as the industry, but telling them that they work hard and they're average doesn't excite everybody. So I got to find something positive to say. But there actually is something very positive that I can say. What's that? By how much? They were 267, and now they're 217. They're 50 days faster. So that's actually the message. You've worked on lean programs. You've worked on Six Sigma programs. You've worked on improving your supply chain, and you've gotten 50 days out of your cycle time. At $60 million a day, that's $3 billion of cash saved. That has improved your performance. Right? Now, return on investment. What do investors care about? Raytheon return on investment, 8 cents in the last year. Still at 8 cents. Lockheed Martin, 7 cents. Raytheon makes more than Lockheed Martin does on a profit margin basis. But here's the thing. Lockheed Martin stock has still outperformed Raytheon. Why? Because investors care about return on investment. 8 cents every 217 days is 14 cents a year. 7 cents every 125 days is 21 cents a year. Lockheed Martin is annualizing a 21 cent ROIC. So that's the point. Even though Raytheon is now more profitable, they're making rounded off 8 cents versus rounded off 7 cents. They're making about 1% more margin. By Lockheed Martin getting 10 days faster, right, 125 days, even with the loss of margin, they're still making 21 cents a year. So they're less profitable, but still generate more cash. Yeah.
So, okay, so what is it that they're returning? Because the government contract, so, is it just that the outside investors that they're making that's bringing back the return? Or?
Well, it's,
Like,
let's say,
what is more efficient is what I'm saying.
so here's an example, and we're going to get into this more, but here's an example. So let's say that we have a contract that requires $1 billion of investment. Okay, just keep the math simple. All right. So if I make $100 million of profit, keep 10% on $1 billion of investment, I make a 10% return on my investment. Everybody with me on that? And just so we see this, because this is on a video too, I'll just jump to Excel. Should be easier to see it on the video if I do this in Excel as your reference. So I'm just saying Made Up Co. is the name of this company. And what I'm saying is profit of 100 million, investment of $1 billion. What if the competitor co makes $100 million? They do the exact same project, but they get the government to front them $200 million. So at contract signing, I get a $200 million payment, signing the contract. But Made Up Co. didn't do that. What happens to the investment at the competitor? How much investment do they have to make on their $1 billion project? $800 million. So, ROIC equals 10% equals 12.5%. That's how you start to see the difference. So, here's the next thing. What if Compete Co. strikes a deal with their vendors for just-in-time inventory? So they don't pay for it until it shows up. Matter of fact, they don't pay for it until 30 days after it shows up. And they're better at logistics. And they got better terms with their vendors. And Made Up Co. didn't really negotiate that deal. So now they have $700 million of investment. And now they're making close to a 14% rate of return for the same level of profit. That's what's happening. That's what's happening at Lockheed. Lockheed is basically getting better negotiated terms on its contracts. Lockheed Martin is getting more efficiency at the delivery of its contracts. So if you get hired by Lockheed Martin, you're going to go through a lot of training on program management and project management. And they're going to teach you how to do it right. And a lot of other defense companies don't do that because Lockheed Martin understands that time is money. And if you're better at project management, you will save time in the project. If you save time in the project, we don't have to invest as much before we get paid. And they're going to send you to project management school as one if you get into the high potential program. And then they're going to hire financial people that make sure that we track all this so they can actually give you information, actually teach you this program. And they run it every summer, right? So basically that's the point. The other firms haven't been doing this. And Lockheed Martin with this focus has been doing this. Now the other firms are smart and they're paying attention to this and they're saying, gee, Lockheed Martin seems to be doing this. What are they doing? Benchmark them. I need to be doing this too. So I'm telling you, for the last 5 years, Raytheon's been kind of doing the same types of things. The difference is Lockheed Martin started on this path in 1999. Raytheon started this path in 2008. So Lockheed Martin's further down than most of the defense and aerospace industry, which is why they're at 125 days. Yeah.
Sorry, are these interest rate lines or are they just subsidies, the government subsidizes?
No. What the government will do is they'll just give you the money in advance. So it's not even a loan. It's a payment. So Lockheed Martin's building the F-35, the Joint Strike Fighter. When they were developing the Joint Strike Fighter, the government would prepay the R&D. You laugh, but the guy that did it on Lockheed Martin contract signing, he was a genius. Because all he had to do was ask. They asked and the government said sure, because the government doesn't care. We're on an annualized basis. We don't even know what money is at the government. It's like pennies from the Federal Reserve. It's pennies from heaven. It just shows up and we spend it. So timing to the government, they don't care. Timing to a private company, I do care because I have to finance it with private money or I can get the government to prepay. The government prepays, I need less private money. So all of the contractors have been doing this. Now the government's wising up. All right, so now the government, matter of fact, there's this guy who's the Deputy Undersecretary of Defense, Ashton somebody, I forgot his last name. But in 2011, he sent out a memo and he basically said, we got to stop doing this. Like we're just shooting ourselves in the foot because we have less resources from the Obama administration and we got to go do more. And all the other government agencies picked up on this. So now the government's stopping this process. So it's actually getting harder to sign contracts and the government to pre-fund you because the government is actually hiring business people that have told them that they're making really dumb decisions. So the government's starting to wise up. So it's actually harder to do some of the easier stuff. But it doesn't mean that we can't do more efficiency because a lot of payments in the defense and aerospace industry are progress payments. So if I can't show progress, I can't get paid. So how do I show progress faster? How do I meet those deadlines? By the way, give me another industry. And don't give me tech because everybody knows tech. Give me something you don't know anything about.
Materials.
What?
Material.
What kind of material?
Mining.
Mining. Okay, so I actually work with Rio Tinto. So I get to go to Montreal and Australia this summer to talk to them about this. So here's Rio Tinto, which is the second biggest miner in the world. So here's the deal, RV. And what I'm going to do is I'll look at their Bloomberg global peers and their biggest competitors, BHP, Billiton. Custom, you don't have this custom screen, but cycle time. Rio Tinto is the second largest miner in the world. Cycle time, 543 days. BHP, 610. Average miner, 865. This is all Sam Bruce. So basically, about a year ago, Rio Tinto fired their CEO and they brought in a new guy. He's an operations efficiency exit. And that's what he's been doing. He's been getting efficiencies in their mining operations. How long does it take to get the ore out of the ground, on a train, to a port, to the factory that's buying it, that's going to melt it? They do copper, a lot of copper, that they're going to then turn into something and sell it. And it's all about, the efficiency of doing that. And you see it show up in their cycle time relative to their peers. Saw a hand? Question? No? Give me another industry. Pharmaceuticals. How about Merck? I don't work with Merck. I work with Lilly and GSK and Endo and a few others. But they're all peers. That's why I'm picking Merck. Check up on the competitors. All right, so here's the deal for the U.S. pharma market right now. Average cycle time, 303 days. Merck is 261. By the way, Lilly, 193. Here's a scary number. Valiant, 636. But let's look at Merck against J&J. Merck makes 16 cents of profit margin, very profitable, every 260 days for an average ROIC of 23 cents. Johnson & Johnson, which is one of the few AAA rated companies left in the world, makes 24 cents of profit margin every 232 days, more margin, faster, 37% ROIC. If you had to predict, which stock do you think has been doing better in the marketplace? Johnson & Johnson. As I said, it's not that hard if you really know what to look at to start to understand the differences between companies. And that's what I'm showing you. This is what is going to matter. These are the metrics that matter. Yeah.
You said earlier that cycle time isn't really used too much.
Correct.
Why?
People go straight to ROIC.
Oh.
They talk about margin, they talk about ROIC. And what I'm telling you is margin times cycle time equals ROIC, and I like to look at that intervening driver because they'll see differences in margin and differences in ROIC, and intuitively the finance people will know, oh, you must be more efficient. But I actually like to show companies the differences in their efficiency because that's the other thing. If I translate it into days, any leader at any company and any one of their employees understands cycle time in days, and it's something they can act on, and it's something I can track against progress over time. So I think it's a metric that should be used more. It's just not. What we'll do is we'll call it turn. So like you'll say inventory turn went from 6 to 8. Right? That's the same thing as saying your inventory days went from 60 to 45. And I just think that 60 to 45 is more meaningful than going from 6 to 8. But we keep saying 6 to 8 because personally, I believe it's job security. Because the finance people want to basically not have the manufacturing people really understand what's going on, keeps us employed. So my job is to get you guys unemployed. Yes? Well, think about that. Who's going to be not a lot of investment? Who would be an example of an industry with not a lot of investment? Don't have a lot of facilities. Service industries might be an example. So a service industry is going to have a much faster cycle time because they just don't spend the money on an investment standpoint. So what would be an example of a service industry?
Consulting.
It's like consulting. So Accenture. Let's look at Accenture. And the big consulting firms. We'll look at global. And again, cycle time. Accenture cycle time is -7 days. What does that mean? Accenture's getting paid before they do the work. We'll do it. Give us 50% up, down, and sign the contract. And oh, by the way, it's all people. We don't have any assets. So high margin business, low levels of return on investment, next to infinite ROIC. Yeah.
When that says without GW, what is GW?
Goodwill. So one of the ways that you could slow down your cycle time is you go buy somebody for a ton of money. So I could take a service business with very low cycle time, acquire them, pay a huge premium to buy them, and it kills the cycle time for my business because I got to earn that goodwill back. So there's going to be a before and after goodwill component. Right? Yes, question here? Same question. All right, so again, I don't want to get too detailed because we're still at a kind of an intro level, but we're going to get more into the trees later. But this is going to be one of the things that we're going to look at for companies. Continuing on. Royal Caribbean. We talked about Royal Caribbean on Monday. So one of the exercises that you're going to have to do this semester is you're going to have to evaluate an ROIC, its components, margin and cycle time, and why it's changing over time. So here is 5 years, the same 5 years we talked about on Monday, of ROIC data for Royal Caribbean. That's the bottom line here. Their ROIC went from 7.5 cents to 5.8 cents per year, per dollar of investment. Now, first, this is cash. So 7.5% ROIC, I can price that. 3% ROIC, I can price that. 6% ROIC, I can price that. So if the growth is relatively certain, or at least relatively unchangeable, then the ROIC becomes the differentiator in the price of the stock. If the ROIC is uncertain and the growth is uncertain, then you can start to see much more variations in the stock. But for bigger companies, the range of growth is not very uncertain, right? So that's the point. If you think about Royal Caribbean, the amount of passengers that are going to go every year on cruise ships, it's probably a range of about that, right? If I'm doing, somebody mentioned, what's the startup car company? Who's making the electric cars? Tesla. Their range is like that. That's the problem with valuing Tesla. Trying to figure out what they're actually going to do in the future, it's a lot of guessing. Trying to figure out what Royal Caribbean's doing in the future, not so much guessing. That's why you tell me the ROIC within a narrow range of sales, I can price you relatively efficiently. Right? So that's why it's easier to start out when you do this with bigger companies, because it's easier to price bigger companies because they're more predictable. It's also why it's harder to make money investing in bigger companies because they are more predictable and the range of variation is much more narrow. But going back to Royal Caribbean, why did their ROIC fall from 7.5% to 5.8%? I'm sorry? What happened to their cycle time? It got worse. It went from 709 days to 780 days. It peaked at 925. That was the building of the ships. What also hurt their ROIC? Their margins went down at the same time. So it takes me longer to make less money. Right? That's not a good trend. Now, I want to compare them against their biggest competitor, Carnival. Same 5 years. Now, here's the deal. Cost of capital for both companies was very similar in the 8 to 9% range for every year for those 5 years. So that's the cost of capital. That's the expectation of investors. So what happened to Carnival's ROIC over the last 5 years? Why? Of the two drivers, what's the reason why? Their margins went down. What happened to their cycle time? It was consistent, but they're actually faster. They went from 751 to 734. So Carnival got more efficient, while Royal Caribbean got slower. Now, here's the thing. Why? Think about narratives and stories, because part of being a good analyst is creating the story from the data. Part of the story we told on Monday was, why is Royal Caribbean's cycle time getting longer? Yeah.
Their strategy is to build bigger stuff. It might be more complicated.
Yeah, they're bigger, more complicated things. I'm sorry I'm repeating because I just want to catch it on the video microphone. Why is Carnival's lower? What could you infer from that?
They're building smaller, quicker boats.
Yeah, smaller, quicker boats are building less boats. So I'm saying two views of the world start to emerge from the two different companies by looking at the data. The data tells me that Royal Caribbean is taking on more financial risk because they have higher cycle times. And the data tells me that Carnival is taking a little bit more of a conservative approach because they're not building as big as ships, and they're probably building less of the ships during this period of time on a relative basis, and they're managing their cycle time. Because think about cycle time. If I have longer cycle times, it's longer before I get paid back. If I take a lot of uncertainty, I want to be shorter. Shorter equals less perceived risk. I have more flexibility. Carnival's taking a little bit more of a flexible approach. Different point of view of the world. And you can see that in the numbers. And that's what we said. When I go on the conference call and I'm an analyst, I'm talking to the CEO and CFO of Carnival, I could ask that. I could say, are you building the same size ships as Royal Caribbean? And I can ask that as a question, kind of knowing what the answer is, almost like a lawyer. And the answer is probably not. They should say no. And if they say they are, then I got to figure out what they're doing differently. But that's where a lot of these conference call questions start coming from, is they're trying to fill in the story that the numbers are trying to explain. That's why the analysts for Apple, for Raymond James, spent so much time trying to figure out why did they miss the iPhone drop? Right? Was it because they really were supply constrained, or was something else at work? And Tim Cook on the call kept saying, no, we're supply constrained. But they weren't supply constrained in China as much, because they were selling in all these other countries. So part of it was probably supply constraint, but part of it was also, because they were supply constrained with the 5 last year, was AT&T and Verizon, and the fact that they weren't selling as much in AT&T and Verizon, and that was their big hit. And that's why there's a lot of concern right now about Apple, because if AT&T and Verizon take the power back from Apple, then how much more are they going to leverage that in the future against them? So it's not that they won't sell the iPhones. It's just, are they going to sell iPhones at the same high prices, making $450 a profit for iPhone? And if AT&T and Verizon can get Apple to lower that price, it's better for AT&T and Verizon. Yeah.
Didn't they just make a deal with a Chinese phone carrier?
Yeah, they did.
So wouldn't that kind of cancel out the future prospect of?
But here's the problem. Once you go past the very wealthy in China, the average person in China is not going to spend $800 on a phone. So yes, you now have China Telecom or China Mobile, largest telephone manufacturer in the world, but you're now also competing with a market that is more price sensitive. There's a lot of cheap phones in China. So that's the point. Are they going to be able to get the same level of penetration in China that they are in the US when the average wage is a lot lower and they're being not subsidized by these Chinese telecom firms? So can they get the same amount of sales? Take away the price subsidy and you have to go spend $700-800 for a phone. I think people are going to have a lot more pause on spending $700-800 for a phone. That's Apple's worst nightmare, is what the carriers are doing is they're trying to push. Think about T-Mobile. What is T-Mobile doing? They're basically saying, you finance the phone. So you're paying the whole value of the phone spread out over the contract. What T-Mobile's trying to get away from is giving that initial subsidy of $450. They're doing it in a tricky way because it makes it look like it's a better deal for you, but it's not. Because they're giving you a little lower rate per month, but they're actually making you pay $450 more for the phone on interest over the 24 months of the phone. So they're spreading it out over time. It's trying to change behavior. And by the way, Verizon and AT&T are looking at this very closely, which is why Verizon and AT&T matched and Sprint did too what T-Mobile did, because they'd all love to be in a situation where we finance the entire phone over the contract rather than giving us a $450 subsidy that they're paying to Apple to give us discounted phones. That's the big change that's happening in the U.S. market, because all the carriers hate paying Apple $700-800 for a phone that they only sell for $300 to you. And then you turn around and buy another phone in 12 months, and then they have to eat that subsidy. And the contracts are harder and harder to enforce. As a matter of fact, you see the contract wars right now between AT&T and T-Mobile breaking out in the market. That's really bad for their business, because what it's doing is it's tearing down the switching costs. Right? And tearing down the switching costs means lower profitability for the phone makers. But that's not going to last forever. Yeah.
What did you say? What if we should have no power in that? Should Apple have power?
Well, right now, Apple's had the power traditionally because we want the iPhone and we didn't care about any other phone. We had to have the iPhone. Now, well, I'll take the Galaxy G4 S4 because you know what? I think it's good enough. And if it's $200 cheaper, hey, I'll buy that one. And that's the problem. Now people have choices. And the choices are not all that bad versus the iPhone. And some people actually prefer it. So that's the point. Apple now has realistic competition. So the power is starting to shift back to the carriers because that's what the carriers are doing. They're leveraging Samsung's willingness to discount and do marketing at the expense of Apple. And Apple is losing some power. And that's the point. They sold less iPhones. Is this the tip of the iceberg that it's going to get harder for Apple? Not that Apple won't sell phones. It's just, are they going to sell as many phones at this ridiculous price as they've been able to for the last 5 years? And people are starting to say, no, we're seeing the first cracks. Right? That's what's starting to happen behind the scenes in the conversation. And we don't know how this is going to play out, right? But that's what people are speculating. Back to Royal Caribbean and Carnival. which company did better in this 5-year period in terms of stock price? What do you think? I'm sorry? Which company did better? If ROIC is a key driver, which company probably did better? If the cost of capital was 8 to 9% every year, what happened to the overall value of both stocks? Probably went down. All right, here's the next slide. This is the 5-year period. This is if you invested in both companies at the same time. This is the relative change in your value. You lost money investing in Carnival or Royal Caribbean. You just lost less investing in Carnival. So what I'm telling you is what you're saying, and should be obvious to you in the prediction side, is what would actually play out in the real world in many circumstances. Right? Assuming, and that's the key, that this is expected to continue as a trend. If people think that the future is far different than the past, this is when it becomes harder to explain. That's the challenge with Amazon. The challenge with Amazon is their future looks completely different than their past. And so people keep thinking, oh, the future is going to be different, so it's harder to value in Amazon. But for Royal Caribbean and Carnival, people aren't thinking the future is going to look all that different than the past. That's why it's pretty straightforward and plays out here.
So you'd say it's a bad industry.
Well, I'm saying that in this industry, if you keep borrowing at 8 and making 5 or 6, I'm not going to keep lending you money. I'm just not. Because all the people that are losing money there are the investors. And I'm not just going to keep building ships as hobbies so that you can have fun building cool ships. Right? You got to go make money on their ships. And so that's the pressure that Royal Caribbean is facing in the real world, is investors are starting to say before, and they just announced ship number 3, which is the next $1.5 billion investment. And that's why the investors are kind of skeptical. It's like, how many more of these big ships are you going to build before we start seeing a return? And at some point, they're either going to make the financing a lot more expensive, or they're just not going to give them the financing if these ships don't eventually start paying off on average for the company. And I can't tell you much more than that because I've actually worked with them and I do know a little bit more about this. But based on publicly available data, those are the questions that the analysts are asking. Right? So back to this. Value creation. What we're trying to illustrate here is one of the core points of value creation is the concept of spread. So let's think about this. If you had a line of credit for $10,000 and you could borrow against this line of credit at 6% and you could invest at 4%, would you do that? Would you borrow at 6 to make 4? Same idea with investors. That's what we're illustrating in the previous slide. Eventually, what I care about is the spread over the long term. But over the long term, you got to have a positive spread. Else, why would I make that investment? All right. So, terminology we'll use in this class. The $10,000 is called invested capital. It's the capital that we borrow and put in the work of the business. It's also called capital employed or net assets. The 6% that I borrow it at is the cost of the capital. The 4% I earn if I invest it is the return on the invested capital. The difference between the two, spread. Positive spread, good. Negative spread, bad. You only create value when you have a positive spread over time. It's not a positive spread every year. It's a positive spread over time. All right? Now, I can look at spread as a percentage. I can translate spread into dollars. So, if I have $10,000 line of credit at 6% interest, that's a $600 finance charge or capital charge, assuming no compounding. If I take $10,000 and I make 4% on it, I'll have $400 of profit. Profit minus capital charge or finance charge is called EVA, economic value added. So in this case, 400 minus 600, negative EVA of negative 200. I didn't create any value borrowing at 6 and making 4. I lost $200 worth of value. Or, saying the same thing, I had a negative 2% spread. So EVA was trademarked by the firm Stern Stewart back in the 1980s. So nobody else can use the term EVA without theoretically paying them to use it. So that's why the rest of the world, including McKinsey, calls it economic profit. So economic profit and EVA are interchangeable. They mean the same thing. It's just EVA is the trademark term. Right? So EVA / economic profit, meaning or in this case, economic profit, not divided by, is the profit after tax minus the capital charge, which is the capital times the cost of the capital. So again, same idea. To create value, you got to earn more profit than the expected profit for the risk that you take. All right. Now, continuing on, we'll start into module 2, lecture 2, which we'll cover again more on Monday. But just to catch us up with the previous sections, this is a graphical representation of Modigliani-Miller. You're going to see it a lot this semester, the blue graphic on the right. So, assuming that a company is worth the sum of its future cash flows, one of the things we're going to do is we're going to break the cash flows into what we call operating cash flows and non-operating cash flows. So, think about Apple. When Apple reported their earnings on Monday, they said they had about $142 billion of cash on hand. So, at approximately 1 billion shares, they have a little less than 1 billion, so these numbers are not exactly right, but they have approximately 1 billion shares, approximately 140 billion of cash. It's $140 a share in cash. It's a few more than that, but it's a rough estimate. The way to think about Apple, non-operating value, 140, operating value at a $500 share price, 360. So Apple is $360 of value per share based on selling iPhones, iPads, computers, iTunes, etc. Apple's another $140 a share based on having a bunch of cash in the bank. That's the total value of Apple. That would be called the enterprise value, or EV. And it is that value that we can then pay off the debt with, and whatever is left belongs to the shareholders. Okay? So again, that's the process we're going to do for valuation, which we'll talk more about in 2 weeks. But what I want to focus on today and spilling into next week is what drives operating value, which is the value derived by selling products and services to customers, your primary means of running your business. So I want to use this theoretical example. So made-up company generates $100 million a year of after-tax profit known as NOPAT or NOPLAT. This company takes 50 million of its profits and it reinvests them to sustain and grow its business. It takes the other 50 million of profits and it pays it out as a dividend. That creates 2 ratios. Reinvestment rate of 50%, 50 million of profits reinvested divided by 100 million of profits. Payout rate, 50 million divided by 100 million, 50%. These 2 rates have to add up to 100% of the profits. Therefore, 1 minus the investment rate equals the payout rate. 1 minus the payout rate equals the investment rate. Everybody with me? All right. 2 definitions for today. We'll finish after these 2 definitions. Definition number 1, growth, also known as little g in the equations we're going to start building, or what's called sustainable growth. This company reinvests 50 million from the previous slide to sustain and grow. New assumption, 10% return on investment. The company made 10% historically, it'll make 10% in the future, just to keep the math simple. So if I reinvest 50 million at 10%, I'll have 5 million of new profits next year. If I had 100 million of profits last year and I keep making 10%, my core business should still make $100 million, and I'll get 5 million on my new investment. I'll have 105 million next year in profits. I'll grow at 5%. Now, mathematically, I can shortcut this growth rate. What's known as the sustainable growth rate, or little g, is the investment rate, or reinvestment rate, in this case 50%, times the expected return on investment, 10%. 10% of 50% is 5%. That's what I can grow at with internally generated funds. Everybody with me? All right, so here's the question. Real scenario. We're doing a strategic planning exercise with a company, and they were talking about Vision 2020, was their 2020 goals. And these are their 2020 goals that they had come up with internally, that they were communicating to the board and now to other people. They said, we're going to grow, I'm not going to tell you the company, and it doesn't matter what the company is. We're going to grow at 15% a year for the next 6 or 7 years. We're going to get an ROIC of 15% a year. We're going to average that. We're going to pay out 50% of our profits as dividends and share repurchase. We're not going to issue any debt, and we're not going to do any acquisitions. So all that growth will be organic. So I heard this, and I went up to the CEO and I said, you can't do it. You got to go back to their board and tell them that these goals are not going to be achievable. And I'm telling you, you got to be damn certain before you go to a CEO and you say that. But how do I know I was so certain that they couldn't meet those targets? Based on the data they gave me on this slide. Why are these targets not achievable? Yeah.
I mean, 15% of the 50 they're putting in is going to give you the 15 growth rate.
So if they're reinvesting, how much?
50%.
They're reinvesting 50% because they're paying out 50%. And the sustainable growth rate is 50% of reinvestment times what? The ROIC. What's half of 15? 7.5. That's your sustainable growth rate, 7.5%. And you're saying you're going to grow at 15. Now, one thing you could do is you could borrow money to grow, to pay the dividend, but they said they're not going to borrow any money. Another thing you could do is you could get inorganic growth, and you could do a major acquisition, but they said no acquisitions. How else could they get 15% growth rate? And I'll go back a slide. How else could they grow at a 15% growth rate? Here's the formula. What else could they do? They could say, increase the ROIC to what? At a 50% reinvestment rate, what would they have to increase their ROIC to? 30%. Well, that's unrealistic because the industry makes 15, and it'd be hard to find all my projects making 30 if everybody else is making 15. So what's my final choice? Reinvest more. But if I reinvest more, how much would I have to reinvest at 15% ROIC? All of it. So how much dividends can I pay? None of it. Well, I can't cut my dividend. It'll upset my investors. You better go back and talk to your board because this is not achievable. That's what I'm saying. The smart analysts start to understand how these numbers fit together, almost like a puzzle. By the time you get to that conference call, you just know what questions to ask because you're just trying to fill in the blanks and test companies when they put out these goals. And part of it is the management literature. In the management literature, you're told by these two professors to do what are called BHAGs, big, hairy, audacious goals, which are the stretch goals for the organization. That's probably what they did. The problem is when you actually put all the stretch goals together, you can't make it. They're unachievable. So you got to figure out where you're going to end up being, and the numbers tell us. Here's the last point I want to talk about today. Free cash flow. The value of a business is not its future profits. I'm going to say that again. The value of a business is not its future profits. And the reason why is because you can't give those profits to the investors. Why not? Because you got to reinvest some of it to sustain and grow your business. So in this example, they're reinvesting $50 million of $100 million. So they can't pay out the $100 million because they spent $50. What's left after reinvestment, profit after reinvestment, is called free cash flow. The value of the business is your free cash flow. That is the profit after reinvestment that can be paid out to the investors. So free cash flow equals the theoretical payout rate. And that is the value of the business. So
That's what you would discount to get.
that's exactly right. That's what we're going to try and forecast and discount to value the operations of the business. And the challenge is the accounting statements don't give us free cash flow. So we have to reformat the accounting statements to create free cash flow. That's the economic conversion that you're going to hate in 2 weeks, right? Because we have to go from accounting statements to cash flow. And what frustrates me is the accountants started with the cash flows. And when they create the accounting statements, why couldn't they just give us the cash flow numbers? Why do they make us do all the work to try and figure out what those original cash flow numbers are? Life could be so much better if PwC and KPMG would just say, here's the balance sheet, here's the income statement, here's the ROIC, here's the free cash flow. Because the sophisticated investors care about this data anyways, and we have to go recreate it all. Right? And that's where Bloomberg to some degree comes in because they're trying to do it. Unfortunately, there's not a standardized definition for free cash flow. And there's not a standardized definition for ROIC. And different institutions have different nuances. As a matter of fact, one of the things Stern Stewart says when they calculate EVA, there's 300 adjustments they make to the accounting statements to create EVA. I can't imagine that you're getting a Frankenstein number that is meaningful when you make 300 adjustments to it. And that's the challenge that we run into in the real world. But nonetheless, we're going to talk about some of the core numbers here, what the most common definitions are, and what they tell us about value, because ultimately it is the free cash flow that becomes the value of the business. Does this make sense? All right, this is where we're going to end today and pick up on Monday. So, a couple things. One, I was told, surprisingly, that the bookstore doesn't sell the book. I don't know why, but apparently it got lost in the paper shuffle. So if you're looking for the book, you're not going to find it at the bookstore. So my recommendation, Amazon. And again, the Amazon Kindle version is one I use. It's pretty cheap, right? But you can find it elsewhere. It's about $40. Yeah.
It was $23.
$23 where?
Book holder.
At book holders? All right, so for those of you listening to the video, book holders, $23 before they go away. That's a really good price for the book. Second, if you're not in a group, you have until next Wednesday to get into a group. Otherwise, on Wednesday, I'm going to put you into a group. So continue your search. All right? 5 to 7. All right? And finally, there is some readings that will help you for next week, because we're going to get even more technical as these days go on. And if you have read the chapters first, it'll probably help you as you see some of these numbers. All right? Otherwise, have a great weekend. We'll see everybody on Monday. No homework this weekend other than get the book and do the reading. Your physical first homework assignment will be given out next week. And do the following week.
Is there a sign sheet or anything like that?
Hold on, let me. There won't be a sign-in sheet until the drop ad period ends. Okay. Just because I want to give people a chance to do that. So not for today. But yeah, thanks for asking.
Did you want us to email you our groups or?
I'm going to wait until